Thank you, Marty. Greatly appreciate that. Just trying to check here. So do we have our last panelist?
We have the two people here.
Yep.
And then we have Chris.
Chris is here.
Chris.
Charlie Callahan.
Charlie is the one I'm checking for. Triangle Ventures.
He is here, and I've actually he's logged on. I've gone to. He was here like 5 minutes. He should be here.
Okay. Well, hopefully he'll be back in a minute.
He's here. Let me just get him.
Here we go. We even have a chair for him. That's good. It's always nice when you have your entire panel there. There he is. He's online. I can see you, Charles. You need to unmute. Fantastic. So thank you, Marty. Greatly appreciate this. And you gave a wonderful intro to the panel. Joining me today is Jack Isaacs of Empire Growth Capital. He's an independent sponsor. George Jones is also there. George, thank you. He's managing director of Woodside Capital, an investment banking firm, broker dealer, capital raiser. Charlie Callahan, who was online, and he's managing partner of Triangle Venture Partners, an investment banking firm. And then we have Chris Anci, Anci Advisors, former operator for a family office and broker dealer advisor. So looking forward to this conversation. My name is Mark Heil. I've been involved in alternatives since the mid-90s in marketing, capital raising, fund administration, and currently be working on becoming a broker dealer myself. So I've been through the business from multiple different angles. Disclosure here is always necessary. This program is intended for educational purposes and should not be considered tax, legal, or financial advice. To the extent I offered an opinion, it's my opinion alone and not necessarily shared with anybody else. For the next 50 minutes or so, we're going to be chatting about private equity and mergers and acquisitions for the remainder of 2023 and into 2024. And I think I read a quote from McKinsey that I think summed up the current state pretty well. It says, the music hasn't stopped playing, but the volume is way down. So I think that's a pretty good insight. We invite you to be part of this conversation. It shouldn't just be us up here talking. We want the audience to chime in with your questions, your interest. We've got some very talented people that can answer your questions. So feel free to come in wherever you see fit. And with that, I'm going to turn it over to Jack, I think, to lead us off here and just give a brief introduction of yourself and talk about, what you're doing as an independent sponsor.
Absolutely. Thank you, Mark. Again, my name is Jack Isaacs. I'm with Empower Growth Capital. I'm an independent sponsor. I started out as a lawyer. I practiced for about 15 years. I have a master's degree in mergers and acquisitions and SEC filings. I then got my MBA, moved into private equity. I've been in private equity for about 17 years. Maureen and I, from the last panel, Maureen Downey, have more than our children in Mandarin in common, because I think we started around the same time. Back when I started in private equity, the great opportunity was you're talking to people who are highly unsophisticated, that have never done an M&A deal, have no idea what valuations are, have no idea what EBITDA is, and they're hiring the lawyer that drafted their wills to actually negotiate against someone who's in private equity. And so you get this real dramatic opportunity in terms of valuations. Since that time, private equity has grown exponentially. The fact that a lot of money has gone into private equity, as Maureen was talking about at the last panel, one of the reasons so much money has gone into private equity is there's been an explosion in the number of private equity groups and venture capital groups. That has been somewhat to the detriment of that advantage, because now when I talk to a company in Des Moines, not only do they know what EBITDA is, and they say, oh, my company is worth 10 times because I saw it on the front page of the Wall Street Journal that's what Google is worth, and I'm definitely Google, but they'll also say, oh, and I have 4 other private equity or venture capital groups have offered me term sheets. So suddenly you have a much more competitive process. What was an inefficient market is becoming much more efficient, which sucks for me. But that being said, there's still some wonderful opportunities out there. And unfortunately, right now, as the last panelist also talked about, now is probably the most challenging time to raise capital in perhaps the last 14 years. So it's an interesting time. I am looking at companies with between 5 and 15 million in recurring revenue. I'm not looking at EBITDA. I'm not looking at cash flow. In fact, if a company has EBITDA, when they're at 5 million in recurring revenue, they're probably not spending capital properly because that money should be going to hire key employees. I invest typically for 3 to 5 years with planned exit. The big differentiator more than anything else, from my perspective, is I'm a minority investor. I want the founder owners to retain control. I think that is really critical. When you have a founder owner or an early stage business, that psychological ownership makes a big difference.
Great. George, why don't you pick up and introduce yourself and talk a little bit about your background and the deals you've worked on. So
sure. So I think our view of the world is quite similar. So I'm part of Woodside Capital, which is actually you can walk over to our office from here. We're a tech-focused, small to medium-sized investment bank. We concentrate on deals that are between $30 and $300 million in total value, and operate more on the sell side than any other side. We do a few buy-side engagements here and there, but most of our work is on the sell side for companies. And the classic case is a company that is either VC-backed or bootstrapped, has gone along for a period of time and is faced with the need for additional capital. And if that's not available, an M&A route is probably the best other option out there. So our deal flow right now is at a record level. Last year was our biggest year ever, 23 years old as a firm. So, there's a lot of activity. Now, I listened to a briefing from the leader of the McKinsey M&A practice yesterday. So it's interesting that came up, and we agree. The music is still playing, but the volume's down. And I think it's measured in valuations as much as anything else. The number of deals that are still getting done in tech, anyway, still about the same. Or a little. It's down from 2021. It's down, but not horribly. So that's kind of interesting. So background-wise, I'm mostly an operating guy in semiconductors. I've done 5 startups. I'm a founding member of Sandhill Angels. In fact, most of our meetings through the years have been here at Wilson Sonsini. So pretty active angel group. I'm not active this year. I've got so much going on in the investment banking side. I took an LOA for the year. At any rate, electrical engineering and MBA background educationally. And Woodside is a little different as a firm in having bankers, managing directors that have more operating experience and less banking experience. And that's really true for me.
great.
Glad to be here.
Charles, why don't you take the opportunity to introduce yourself, and then we'll go over to Chris.
Hi, I'm Charlie Callahan, and piggybacking on what Jack George said, I come at it more from an operating perspective. My career started in the management consulting business. I was a partner with Booz Allen and Hamilton, ran their technology and strategy business on the West Coast, morphed to a turnaround in the enterprise software space, headquartered in Europe, part of the lead team that sold the company. Been a CEO of a venture-backed company and a co-founder CEO, and have been doing M&A in the late stage venture arena through the lower middle market for 15 plus years. Triangle Ventures is a turnaround advisory and M&A firm. Our target space is technology, fintech, some consumer. The environment in which we are in right now is basically unprecedented for the last 10 years. We've been so used to a zero interest rate environment, easy money, quite frankly, frothy, and I'm being gratuitous, valuations. And now we're in a mode where we're back to reality. I agree with your McKinsey quote. On the other hand, the private equity players that we deal with, their objectives are still the same. They're looking for targets that they can 5 to 10x or more, and they're looking to how can they grow them beyond what they are. Our focus in underperforming late stage venture companies, not unlike what George talked about. They've got funding, they've hit a wall. They, for whatever reasons, the VCs are not an active voice. They can't, if you will, transact them, and so they're left to their own devices in terms of what an exit might be. IPO, particularly in the last 18 months, is not an option. M&A and secondary to a lesser extent is the name of the game. So what we're seeing is really a metamorphosis of sorts between companies that are good companies but have fallen on hard times. A recent quote from Carta, who's really the go-to cap table provider, indicated that in Q3 now, they've seen the biggest uptick in bankruptcies and dissolutions for late stage venture companies. Now, whether that's a singular data point or whether it's a trend line, we don't know. But it really paints the environment that on one hand, the not so good companies have dissolved in one way or another. Maybe they didn't have enough cash to deal with the runway, whatever. On the other hand, those that are survived are, quite frankly, better companies than they were 12 to 18 months ago. So with that, I'll defer back to Mark and look forward to the discussion.
Great. Chris, why don't you take a few minutes, introduce yourself, and tell us what you do and how you can be helpful to people in the room.
Yep, and I'd like to thank everybody for having me on the panel. For a little bit of a brief background, won't go through the whole litany. I ran my own broker-dealer for about 17 years. That business was involved in primarily, it was a trading operation because during those years, that was a very good business. Had a fund administration business that catered to 40 Act mutual funds, and it also had a small investment banking team. When the hedge funds trading through me decided to go into sub pennies, in terms of what they were paying me, I saw the writing on the wall. I started out at 20 cents a share and $4 a bond, and I left with 2/10 of a penny and bonds were free. On the fund administration business, I rolled that out. I've kept my banking team in place the last number of years, but I also was fortunate enough to work with a large New York City real estate family. One of the members there decided to open up a small family office, and for the last 8 years, was working with him as both sort of a kind of a consigliere because he's a little bit new to the financial markets. CIO, COO, small shop. We ended up probably making about 35 plus, primarily Series A investments. We did do venture, but the temperament wasn't there for him to handle that part of the conversation. As we all well know, the distance between post revenue, better revenue versus burn rate to revenue is definitely shorter. With that said, so it's been an interesting number of years for me to both simultaneously working on the buy side and the sell side, because I can see the kind of due diligence and the sentiment that we put to place when we were, going to put his money at work. But then I also saw how the customers on some of the banking deals on the sell side, how those high net worths and everybody. So a pretty good lay of the land, obviously not a full statistical model, but you can get an idea of what people were thinking. I think we've touched upon partly on the last conference was sort of the last panel was touching on towards the end. I think part of the conversation on lockups, not meaning that people are locked up. There's an awful lot of money that has been allocated to private equity over the years. We, in particular, our group, have a very good investment that's now currently doing a Series E. And some of our guys who've been in it from A are going, wait, time out. I'm thinking of going the other way here. I'm a very appreciative of the 20 plus X, but as one client said to me the other day, he goes, I want to buy a boat. I don't want to buy my grandkids' boat. So I think that's a very good, I think that was I think when they touched upon the fact that so much money has moved into these deals, I think people had a 5 to 6 year, maybe whatever timeline. Now that's being moved out. And if everybody runs to the exits, that's an interesting, thread for all of us to think about. I think everybody's touched upon it. Rates matter, right? And I would gather probably from the vast majority of those of us in the room or online, we remember a world where rates were normalized and cost of money was more within historical trends. The last 20 years, sort of this Fed, I call it a counterfeiting regime, but that's another argument. People have to get to work now, and there's a generation and a half behind us who have never seen business operate in the normal course of business. So George touched upon the fact that he's busy, right? But he's busy because he's in the semiconductor world. That's real money. That's smart money putting to work in very in smart projects. If you've got a lot of people buying, consumer or whatever at 10x their, $3 million in revenue, that's going to get pretty complicated for a lot of people over time. So I look forward to the further part of the discussion, and glad to be here.
So as you can see, we've got people that are well-versed, real players in this market who've seen a lot of action over the last few years and currently seeing the action. So this is going to be a great conversation. And Marty, yesterday you had on Axel Merck, who was speaking on the economic outlook, and he said that he looks at this as a risk mitigation, not as an economist, and he was trying to really figure out whether it's going to be a hard landing or a soft landing. And I think he came down a little bit on the side of hard landing, but that's not my question really is to this group. My question is for the fourth quarter, 2023 and into 2024, what are your perspective of what's going to be taking place? What's this going to look like? And maybe we'll begin this with George, since he's the most optimistic and having the most, having a lot of business right now. So George, maybe you want to lead off with this.
Well, please don't misconstrue the optimism. But after years of being inconsequential, being in semiconductors is a great place to be right now. So we've got a little more exuberant because of that. And I've got a string of clients that are and buyers that are taking advantage of government incentives, both U.S. and elsewhere. So those are non-trivial. They're also not easy to obtain, and so there's more to it than you might think. So the secular cycle of building up semiconductor manufacturing capacity and investment in new companies and new designs and new technologies is of real significance. And there's some breakthrough technologies that are of real importance. Some of the most significant of which are on the power side. So things that power automobiles, specialized what you call wide bandgap processes that are used by those that are far more efficient than anything else you've seen before. So that's just one example. There are breakthroughs on multiple fronts. There's some great data center solutions for high performance computing out there, and AI is driving stupid amounts of investment, although generative AI is sort of a thing in semiconductors. There are a few specialized processors, but not a pure play in that. Nevertheless, the type of I want to tag on to the other thing that makes me excited, but is also is cautionary. A lot of the deal flow I'm getting right now is VCs that are pruning their portfolios. It's either they've got some undervalued assets they're worried about, and time is not a big deal. But in many cases, it's later stage funds, that are at an 8 or 9 year point, and they've got to do something now to be able to return money to the LPs at the 10-year point.
George, you didn't how could you not mention the CHIP Act?
Well, government incentives within that category.
That's a pretty big incentive.
It is. It's $52 billion, divvied up in multiple ways.
And can you say what that is? What's the CHIP Act?
CHIPS Act.
Oh, okay, I'm sorry.
Yeah.
So part of the broad, a year and a half ago, all the incentives got passed. So this you've seen some examples of big fabs being built in Arizona and Ohio, and those are being fueled by CHIPS Act money. So this is it.
Yeah, no, I just, come on,
I
you're
should've
in
said-
Seneca, how could you not mention, this huge infusion of capital into this space?
Thank you.
Yes.
Absolutely. Charles, you want to follow up that and throw in your thoughts as how the fourth quarter 2023 and 2024 is going to go?
It's tough to give a composite, if you will, but at the risk of getting out on a limb here, I will. And this is really one part our target companies or those that are looking to, for an exit, which is late stage venture-backed companies, and as George mentioned, typically part of a mature fund, if you will, that's looking for optionality in the later innings, if you will. And then the flip side of that is the prospective buyer space, and those are the low end private equity folks, high net worth individuals, and we're getting some play from the family offices as well. From the perspective of the company perspective, it's all about short-term optics. Again, the Sequoia came out last spring, last May, with a buckle down, worry about runway, cut your costs now, et cetera. Everybody's got that message and prescription and are looking at it. The VCs, all of them, top to bottom, have triaged their portfolios, decided which ones they're going to continue with, which ones they're going to dump, and which ones they're trying to sell or whatever. The company perspective is month to month. Manage cash, manage the burn rate. Don't lose any customers, and hang in there, because it can't do anything but go up. The flip side of that is when, and these folks on both sides don't see an immediate turnaround. This is not going to be a V-shaped recovery, if you will. It's going to be a while before we get to a point where interest rates go down. The risk averse people are becoming more aggressive and such in terms of looking at companies. The bar has raised on both sides of the equation. The private equity guys are still, again, yes, the volume is low, but their objectives, remain the same. They're looking for good opportunities, platform companies that they can build off, opportunities that they can get at a lower price point than they could have 9 months, 18 months, whatever. The private market valuations have just been ridiculous. If you look at a company like Instacart raised money at a $40 billion valuation once upon a time. They cut it when they backed away from the public markets to 24, and did a financing at 24. They just went public a few weeks back at a valuation of 10, would you believe? And they're trading at 8. So if you were anyone beyond a B series player and they did 19 rounds of investment, you don't have any money coming back to shout about. Yeah. So so again, there's a lot of optimism that this is a good time for buyers, and the sellers are saying, hey, we've hung in there, if you will, for 12 months plus, and we're better off now than we were. So short term, it's not gonna be over, until mid 2024, when we really see a bona fide uptick. On the flip side of it, there are still deals being done, albeit a much smaller scale than before. But again, the objectives of both sides is still remains the same.
Chris, we've heard a lot about pruning, triaging, and doing different things, and at the same time, a lot of family offices, such as the one you worked with, build up a portfolio over the last few years. I think you said you brought in 35 companies into one particular family office. As you are thinking about things today, and as let's assume that you can get engaged with a family office, how should they be thinking about their portfolios today?
That's a good question. And what going back to the previous comment about the end of 23 versus 24 kind of dovetails into that. In traditionally in the markets, there was sort of cycles as to how things worked and when calendar events took place, right? So if you take this time of year, you've got October mutual fund rebalancing, you've got people trying to close up for the rest of the year, and then you also have people who have to put money to work, right? So speaking to people that may be running credit funds or stuff like that, there may be insurance companies and or pension funds, and everybody else who are paid to put money to work. They can't go into year end showing cash, right? So that was always sort of an impetus for some kind of movement or price discovery within the market, right? When you look at family offices by definition are mercurial at best, right? I mean, they all have their own sort of nuance. So they're not, you go to 12 pension funds, you take 12 pension fund guys out for a night, you're talking to, who you're talking to, right? Take 12 family office guys out, you may have like very interesting conversations because everybody's made a lot of dough in a different way, right? So they don't all behave the same. So you have some family offices are working with different mandates. So you take who are building a portfolio specifically, and just so everybody knows, the guy that I was working with unfortunately passed away at the age of 63, left a train wreck behind him in terms of a whole bunch of other stuff. So they kind of wound down our office. But you take us, he was looking for something non-correlated, right, to what his traditional source of wealth and income were. It varies across the board. I do think that you will see people, I think you'll see people pulling back, but they also get shopped a lot of things, right? So when you put the sell side hat on, the old saying is, why do people rob banks? That's where the money is, right? So why is everybody calling on family offices with these private deals? Is because that's where the money is. I think we were talking about it the other day on our call. People can mention, oh, do you know this XYZ firm? No, never heard of it. They've got $6 billion. You're like, really? And then, or do you know these guys in Seattle? Never heard of them. They got $4 billion. I mean, the pockets of money that are around this country, we don't even get into offshore, is amazing, right? They will be offered more opportunities. The question is, I think they will be slower, right? And then because I think what they will be offering will be reflected the new world that we're in, right? They're not just going to be, these high flyers trading at 10 or 15 times EBITDA and all this other stuff that everybody throws around. I think that they're going to be shown more, maybe credit funds, maybe stuff that fits this environment a little bit better. And lastly, on the collective point, in terms of 2024, I always say to my kids, nothing, most things are neither good nor bad. It's all a we'll see moment, right? Because sometimes the best things that happen to you turn out to be the worst and vice versa. So everything, we'll see, right? I don't really know how 24 is going to play out given the geopolitical situation, and we got an election year. We don't know what the Fed's going to continue to do with rates. The inflation bugaboo may or may not be over. So I think that it's a time where you have to be deliberate. I think it's a very, very focused time.
Yeah, and I think that was sort of the tone of our prep call. It was very realistic, very down to earth, and some of the comments I heard were capital raising is difficult, bank debt is scarce, exit options are limited. Not really encouraging news for Jack, who's got two companies that he's looking to invest in and trying to raise capital for. But there are also some upsides. The valuations are down, they're more realistic, there's less competition in the market. And there are pockets where deals are getting done. Good deals always get done, right? And there's significant amounts of dry powder on the sideline. So for the people that are trying to raise capital,
it's not all bad. right?
It's not all bad. It's
you know,
there's a mix, right?
the wake of the .com crash, you ended up with Google and everybody else. And then in the wake of 2008, you ended up, 3-4 years later with mobile web. And then, and mobile web then created all the geolocation businesses, and you ended up with the Ubers of the world and all that. So there's always something coming, whether or not it's AI or not. Like, we all have to wait and see on that one. But it's America. There's something coming for sure that's going to be bullish.
Absolutely. So for the people that are raising capitals or looking to sell their businesses, how are these how have these factors affected the deal structuring and the negotiations that take place? And I don't know if Charles, if maybe you want to lead off here, or if George does, but start off with one of you two.
I'll take a shot at it and try to be brief. A good percentage, certainly north of 50% of the companies that come to us and want an exit of some sort, looking to sell their company, they aren't prepared. And I always use the phrase, they don't know what they don't know. They think that, okay, we've survived and we're an attractive player. We've been at it for 5 years. We're cash flow positive, blah, blah, blah. Okay, great. On the other hand, you have to be attractive to a very different sort of discriminating buyer, that the bar is significantly higher than it has been. So a lot of our work is getting some company prepared, if you will, to sell, such that they will be the most attractive player of somebody in the. Hello.
Here, there. I hear you fine.
Yeah, so that they will. I lost my screen. I don't know whether you can hear me or not, but maybe
we can hear you.
Okay, well, I'll finish it up and turn to George, because I'm not sure what's going on my end here, but again, I think that there are, echoing the train of thought here, there are good opportunities. There are just fewer of them, and the due diligence is significantly higher and more time than it ever has been. Okay, I'm back. So hope that helps on on both sides. With that, I'll toss it over to George.
Yeah, so we see the same factors. In terms of the negotiations, there's a lot more earnout and a lot less cash consideration than we could see a year and a half, 2 years ago. I just closed the deal about a week ago. This is now public, with a company named Invi Semiconductor, who acquired a private Swiss company that we were representing. The top line, or the headline acquisition price was $65 million. 20 of that is earnout. Now the good news, and that was, there was a lot of negotiation to get to that number. So it was going to be a lot more earnout originally, and it took a lot to get to that valuation. So this is a pretty hard fought negotiation. In this case, the buyer was pretty motivated and wanted to move fast. So we went from LOI to deal closure in 6 weeks, which, we moved right along, especially considering the international considerations and other
that's really
factors. Yeah. But the company was clean. The data room was thorough and well done. The financials were well managed as a very well run Swiss company, and so the cleanliness of it was really well.
Hey, Jack, maybe you want to give us the flip side with the two companies that you're out with. While we're on it, give us sort of the, if you would, the teaser overview of the firms too, and then talk about your experiences in trying to raise capital for them.
Thank you, Mark. I appreciate you giving me the platform here. So both of them have, they both have kind of hot areas right now, which was not necessarily why I was going after them, but one of them is is a UK based fractional attorney firm. All they do is business law for early stage companies at a much cheaper price. It's subscription based, so it's LLCs, employment agreements, just kind of blocking and tackling for early stage companies that can't afford. I'm sorry to say this, but typically a Wilson Sonsini.
Hey, Jack, but I don't mean to interrupt you, but just so there's no confusion in the room, why don't you define what a fractional law firm is? Because
Yeah, well,
yesterday they
that's-
heard about a fractional art dealer, which is something very different.
Right. So you pay an annual fee, you get a certain number of lawyers' hours, you get a certain number of documents. So you know ahead of time what your costs are going to be, how much money you have to spend. If you have to go over that amount, they have preset prices. So if it's an employment agreement, you'll get a much better price because you're a subscriber to this service. So it's a way for small, medium-sized businesses to kind of figure out what their costs are going to be and what they can afford and how they can afford it, as opposed to when you typically go to a law firm that want an employment agreement, you have no idea whether it's going to take them 1 hour or 20 hours and whether it's going to cost you, $200 or it's going to cost you $20,000. And that tends to be a real problem for early stage businesses, which have real cash flow problems. So this is a UK-based business that is moving into the US with $100 million plus US partner for the first time. Company's been in the UK for 11 years. And one of the things that makes it really appealing is they were smart enough to incorporate AI into their software, which they've now been approached by 2 different very large, well-known legal service firms to acquire them. They don't want to get sold yet because the opportunity to move out into the US market, company is going to be worth a heck of a lot more money. And so I was able to structure it, but I think it's very smartly because it's hard to raise money now. So I am putting in $4 million as a senior secured note, but I get warrants for 20% of the business. So the debt, which is at 12%, 12% is not a great return. At this point, it's practically giving it away because considering interest rates, but owning 20% of a business, which is going to explode in the US market, is pretty damn exciting. The second opportunity also kind of has a sexy side to it. It sounds confusing, but it's much easier than it sounds. Commodity futures trading software. So you can trade up to 40 different commodities on the platform. But the real benefit is 70% of their revenue is in the energy space. More than 25% of their revenue is in clean energy. With what's going to be passed in California this month by Governor Newsom with regard to greenhouse gas emissions that are going to be required for companies that are more than $1 billion in this state, or what the SEC is going to be voting on by October 31st of this next month. With regard to also really they're referring more to carbon emissions. People are going to be trading in carbon credits. People are going to be trading in windmills and turbines and solar and a whole lot of areas which up to this point have been somewhat slow. But there's really an opportunity in this space where I think this is really going to take off. The company has grown 65% every year, more than 65% every year for the last 3 years. This year, they're growing more than 100%. That one is structured slightly different. It is a $6 million investment with a 1.5 times participating preferred, meaning you put in 6, you get back 9, plus an 8% accruing dividend. So basically almost 2 times your money back, plus you get 22% of the business. So it's kind of left, different sides of the balance sheet, but very similar structures. And I'm very proud of the terms, and I love the management teams. I have Kroll doing quality earnings reports. I have people scrubbing the IP. So I need to raise $10 million now. So if anyone has $10 million, they can write me a check, or a $4 million check and a $6 million check. That would be great.
Well, maybe they want to come up to you and get an NDA done and start really diving in. And certainly I would encourage people, if you've got an interest in what Jack has spoken about, to certainly approach him during this conference. Chris, I want to come your way. I want to talk about the exit markets. We've touched on them a little bit. We heard Charlie a few minutes ago talk about Instacart and what happened there. But we also heard Marty in the upfront talk about, the large companies now, actually trying to raise capital or have cash on hand through doing carve-outs or spin-offs or things of that nature. So talk about the exit market for us a little bit. Who's buying, who's selling? I mean, who's buying and what are they looking for? You're muted, just so you know.
Sorry about that. From a very personal perspective, like I mentioned to you guys before, we have this one investment. We're actually doing this Series E right now. Home run company. The whole thing's booming. If anybody wants to know what it is, they can reach out to me. But we have early investors who are looking to get out, but it's going to be complicated. Now, the private markets obviously have no obligation to make a market, right? So there's no specialist or $2 broker running around where, you have to make the market. So if somebody wants to get out, the company's going to either, the company or their banker or whatever will try to accommodate the sale. It will most likely be at a discount, right, to whatever the current valuation is. And it could, present some issues. And I think that has the possibility, to be a curveball for some people that they've been in. Everybody's looking at their gains, and all of a sudden, if you sit there and you're like, whoa, I can't, it's all on paper. I mean, you don't even have any margin against it or anything like that. It's just really big. In terms of what I'm hearing is like sort of the M&A calendar, or people, there may be some targeted acquisitions, but I think a lot of those guys are going to be dusting themselves off a little bit to probably mid-24 is what I'm kind of hearing. Like some of the bigger serial, roll-up guys and stuff like that are pushing this out a little bit on the calendar. So, look, the market will thaw. Where it thaws first, we don't know. But I mean, these things do all sort of play themselves out. And I think, look, if the Fed comes out in November and says they're done, right? I doubt they're going into a cutting cycle. But if they at least say they're done, that could have some people could put money to work. And then lastly, I mentioned before, the term price discovery. Price discovery is very important, right? And we live in a world where when you have a lot of government in there, right? When you have a lot of government money or influence in things, there's nobody knows what medical costs should be because there's just too much noise in the system, right? Nobody knows what higher education is supposed to cost because too much noise in the system. So it's called price discovery. And you take, like, in particular, you take the New York City commercial real estate market, there's been no real transaction, right? There's been a couple of auctions. There's been a couple of things where people work things out vis-a-vis debt. But there's been no actual, somebody has not come out and bought a building, right? And that's what everybody's waiting for. Everybody's waiting for somebody to buy a building so they can figure out what the price is, so everybody can adjust from a Class C to a Class A, right? So I think you're going to see the same thing in terms of private markets, which is, a lot of guys didn't do, a lot of bigger companies like Instacart, like a lot of guys in that sort of unicorn area, they didn't do any rounds because they all would have been down rounds, right? So I think everybody's waiting for something to happen. Maybe it is an Instacart moment. Maybe they set the price. Who knows, right? But I think once that lay of the land is out there, the Fed sort of clears up the noise, I think you'll start seeing, people starting to know where things are and they can put money to work.
Gotcha.
Hey, Mark, we got only 2 minutes left.
Oh, in that case, then I had a few other things I was going to tackle, but being that's where we are, I'm going to just ask everybody for their concluding statement here, if you would. What would you, keep in mind we're dealing with family offices. What would you tell family offices right now about the private equity mergers and acquisition markets and how they should approach it?
If you want to be
George, I'll start with you.
Yeah, so if tech focus is interesting to you, there are a couple of sectors that are interesting and worth considering. Semiconductors are on a secular upcycle. The industry as a whole will grow from about $500 billion to $1 trillion between this year and 2030. So it's big growth and fueled by things like the CHIPS Act. I would be skeptical of generative AI. I truly believe it's overinvested already. And even though it's going to derive a lot of great benefits for every industry on the planet, I just don't think it's real investable for the most part.
Jack?
I'm going to say something completely different, and I apologize, but This is my fourth time speaking at one of Marty's events. And every time I've kind of flown in and flown out or gone on Zoom. And I'm going to tell people who are at home through Zoom, next time, come to one of these events. It was a joy and a pleasure last night getting to spend time with some of these speakers. It was just amazing. It was such a great experience for me, actually spending like the first time actually getting to talk to people and pick their brains. So just to folks in the audience, folks on Zoom, next time, try to make it to the event.
I'll concur in that thought. Chris, I'm going to toss it over to you, then we'll go to Charles to wrap it all up.
Yeah, I'd like to say thank you to Marty and as well to go off of what Jack said. I think look, it's venues like this where people that are like-minded and work, hashing out the issues is where ideas come from, right? And connections made, and that's basically, and relationships are formed, and that's the business right there. So as Jack said, he met a bunch of folks at dinner last night. This is how stuff happens, and I think it's great.
Absolutely. Charles, final word.
Final word to the buy side folks. It really begins with be patient. There are good deals out there, but you don't have to jump on the first, second, third, maybe even the 20th. It takes time and continue to evolve and refine your target metrics and target space. Stay away from the one-hit wonder type of deals. And again, be patient and be ready to do a lot more due diligence than you've ever done before, recognizing that you're not going to get something that's totally clean, regardless of how much due diligence. You're gonna get some level of fixer-upper, and I use that not facetiously, but whether it's your job, if you will, as an investor, to understand what you can do to fix it, if you will, and remedy it and get it on a growth path. That may already be happening, but it's incumbent upon you to take that on as part of your buyer optics. With that, thank you all.
Yeah, great job for everybody on the panel. As you can see, these guys are in the trenches. They're doing this business every day. Yeah, I think you got a lot of great insight. And Tyson, are you running the next panel?
I am. I'm ready to go.
This audience is in for a treat. Tyson always does a great job. So thank you, Marty. I'll let you do the intro of Tyson and his panel. Greatly appreciate it.
Thanks, guys.
Thanks, guys.
Thanks, Mark.
Thanks so much, guys. Great job.